So hi guys, this is SJ speaking, and in today's video we're going to see about what is initial public offering, that is IPO. So before going to the video, I'm personally teaching trading. So if you want to join my mentorship course, you can contact me from the number in the scrolling below. I'm also providing discounts for my course. So if you're interested, you can join my course. So now let's go into the video. So what is initial public offering, IPO? So when a company for the first time, that is a private limited company, for the first time issues shares to the public, it is known as initial public offering or IPO. So IPO is also known as primary market. So this is where the company directly issues shares to the public. So in the second, so only after this IPO process, the company gets listed on exchanges, stock exchanges such as NSE or BSE. So after being listed, it becomes a private limited company. So only then in the secondary market, that is the stock market, we trade. So investors trade among themselves. So the company has no participation in the secondary market, that is stock market. So in the exchanges where we are trading normally, so the company has no participation in that. Only the investors transfer the shares among themselves and do trading among themselves. So this is the difference between primary and secondary market. So the IPO process is done by using the underwriters. So the company appoints certain underwriters for doing this IPO process. So the issuing company appoints either an individual or any investment bankers for doing the underwriting process. So an underwriter can either be an individual or a merchant banker, that is an investment banker. So why the company approaches this underwriters? Because if the company first issues for around 10,000 shares, so not the company has no guarantee that all those shares will be brought by the public. So in order to be guaranteed for all the shares being subscribed by the public, the company appoints certain underwriters. These underwriters give guarantee to the company that they will sell all the shares to the public. Suppose if any number of shares are not being sold, for example, only in this 10,000 shares, only 8,000 shares are being subscribed by the public. The remaining 2,000 shares will be brought back by the investment bankers, that is the underwriters themselves. They use their own money to buy those shares, to buy the unsold shares. So this is how the underwriters give the guarantee to the issuing company. Since these underwriters are taking a risk, the issuing company gives some commission for these underwriters, which is known as underwriting commission. So how this commission goes to the underwriters? Suppose the underwriters make a deal with the company, they are buying all those shares for 140 rupees, for example. If they are buying for 140 rupees, they resell to the public for 150 rupees. So the remaining balance between this 140 and 50 is 10 rupees into the number of shares. So this is taken as the commission. This is taken as commission by the underwriters. So this is how the underwriting commission takes place, goes to the underwriters. So suppose if only partially the shares are being subscribed, the remaining unsold shares, in this case 8,000, or the remaining shares are brought back the underwriters themselves. So this is how the underwriting process takes place. Also the company might be reputed or not reputed. In case if the company is not being reputed that much, if the company appoints these underwriters approach the investors and they increase the goodwill of the company. Goodwill is the good name for the company or the projected value of the company in the future. They say the investors about what this company does, what are the products and services this company provides, how the value of the company would be in future. So it says all about the benefits of this company. If you subscribe in this company, you will get these benefits, and what are the risk involved if you subscribe in this IPO process. They will say all those to the professional investors, and they make sure that these investors subscribe to this IPO. So also there's another thing. Even if the issuing company has no that much reputation, if the underwriting company has a reputation, then the investors have confidence in the underwriting company, and they issue to the and they subscribe to this IPO, that is the issuing company. They subscribe to the shares of those companies. So this is another benefit by using the underwriters. So this is how the underwriting process takes place. And next, how to apply for IPO. So applications of IPO is done either through the ASBA process or UPI process. ASBA is known as application supported by block amount, or UPI, as we already know, Unified Payments Interface. So so the ASBA is provided only for the brokers who are having banking facilities such as ICICI or HDFC or Kotak. They have HDFC Securities, ICICI Securities. Whereas the discount brokers such as Zerodha and Upstocks, they don't have the ASBA facility. They only use the UPI facility. So, for example, how to apply for IPO in case of using discount brokers such as Zerodha, you can go to the Zerodha Kite app in mobile or in PC, and you can log in and you can go to the orders and you can find the IPO, and you can find the IPOs which are currently going, or you can find the upcoming IPOs, or you can go to Zerodha console and you can find the under portfolio, you can find the IPO and you can visit there and you can apply for your IPO. Or if you are using this ASBA process too, you can use the you can also use this ASBA and you can apply for your IPO by using other brokers such as ICICI Securities or some other brokers. So once you are applying for your IPO, the suppose if you are applying for around 10 lakh, sorry 1 lakh rupees, your amount would be blocked in your banking account. In your banking, your amount would be blocked, and only when your shares are being allotted, this amount will be withdrawn from your account. Or if you are not being allocated, then these funds will be unblocked. Only after being unblocked, you can use these shares. Until then, you can't use these shares which you are applied for application of the IPO process. So this is how this takes place. What are the types of IPO issue? There are two types of IPO issue. For the first thing is fixed price issue, and next is book building issue. So what is the difference is that in the fixed pricing, the company fixes a price. For example, 250 rupees means the pricing is predetermined and all the investors know at what price the IPO is going to take place. The offer price is already being known to the investors. Whereas in a book building process, this is fixed price and this is book building. In the book building process, the price is determined only after receiving the bids. So investors know only after the demand for the shares is known. So here the demand is known only after the close of issue, whereas here the demand is known every day during the bidding open period. The payment is made on the fixed pricing issue. The payment is made at the time of application, at the time of subscription. But whereas here only the payment is taken only after the shares is allotted. The payment is not taken if the shares are not being allotted. So this is the difference between these two issues. The major thing is that the issuers often use this big building process nowadays. The fixed pricing issue is not being used nowadays. This is because the book building is advantageous to the issuing price since the demand for the shares is known. If the demand is not known to the issuing company, suppose if the company issues at a higher price, for example, if it issues at 500, but the actual demand is not that much, the IPO may not be get subscribed by the public. So this is one disadvantage. This is disadvantage for the company. Suppose if the price is if the company lists the price at a lower price, so it might be even though in the market the demand might be high, but the company issued at a lower price, it is the disadvantages to the company. So that is why the demand is not known in the case of fixed pricing issue. That is why many companies in nowadays all the companies they are using this book building process by appointing the underwriters. So let's example in this book building process, what takes place is that the company issues a price band of around 250 to 300. So this is the floor price and this is the cap price. Below this floor price you can't bid, and above this cap price you can't bid. The cap price is also known as ceiling price, and there is also a rule. So the cap price can only be 120 percentage of the floor price. It can't be more than that. So 150 percentage of the floor price only cap price can be. In other words, you can say it can be more than 20 percentage of the floor price, not more than that. In this case, 250 means 20 percentage of 250 is 50 rupees. So it can be only maximum of 300. It can't be more than 300. So this is one rule. And the tick size means is the for example, if you are bidding, if the tick size is 5 rupees, you can only bid on 250, 255, 260. If the tick size is 60, 10 rupees, you can only bid on 10 rupees on the basis. The difference between each bid would be 10 rupees. Till 300 you can bid. So this is the tick size. Lot size, you can't bid for a single share in an IPO process. There is specific lots and lot size for each IPO issue. Suppose if the lot size is 10 means you can buy 10 shares or 20 shares or 30 shares. You can buy like this. You can buy in one lot or two lot or three lot. You can buy like this. So this is the lot and lot size. And then comes the cutoff price. Cutoff price is also known as the final allotment price. So based upon all the bids received, based upon the demand for the stock, where the stock has high demand, so that price, that bid price would be the cutoff price. and after the allotment price is mentioned, those who bought at the cutoff price or above the cutoff price, they are only eligible for being eligible for the shares. They only get the shares allotted, whereas those who have bidded below the cutoff price, they don't get the shares allotted. They won't get the shares. So I will give you an example. See here. Here the number of shares for sale is 20 crore shares. So suppose if the bid price is here, so you can see the tick price is 10 rupees. So the bidding difference is 10. So the tick size is 10 rupees and the floor price is 250, cap price is 300. So these are the number of shares demanded. The total size is 20 crore. So the highest demand is here, this price. So this 12 crore. So this is taken as the cutoff price, and all the 20 shares will be given those who have bidded at the cutoff or above the cutoff. They get the allotment. Those who have bidded below the cutoff, they are not allotted. They are not allotted, and their money is being unblocked from their bank account, and they can use their funds from there onwards. So this is how the book building process takes place. The underwriters do these things. The book running leading managers do these kind of, sorry, the registrars do these kind of things. And there are also several process, other things such as red herring prospectus, so which are done by the book running managers, and there is a gray market and several other factors which I have discussed in another video regarding this IPO. So this is enough for this video. So hope you have got a good clarification about this IPO and what are the types of IPO and how to apply for this IPO and the book building process of IPO. So if you enjoyed this video, give a thumbs up, like and share, and subscribe to my channel. Share it with your friends and family, and also press the bell icon on so you get notified for all my videos, and also comment on my videos if you liked it, so it will be a motivation for me. And if you want to learn trading from me, you can contact me from the number below, which I have given on the scrolling, and I'm also providing discounts for the first 25 members for my trading mentorship course. Other than that, if you want to open a demat or trading account, you can I have given you Zerodha link on all my YouTube descriptions, so you can visit and open your demat and trading account and start trading or investing from today onwards. Other than that, if you want to listen my videos on Tamil, I'm having another channel, SJ's Trading to Tamil. You can watch that channel too. So thank you guys. I'll visit you on my next video. Until then, bye bye. Take care.